Let's talk about the elephant in the room. We're now in the heart of tax season and you're likely not happy about it. Trust me, I'm not either. But let's talk about a few things that may help you better understand your tax obligations to Uncle Sam. Hey MoneyLion, my name is Hankwitz and I talk about personal finance and investing online. I grew up in a small town in Northeast Tennessee and probably like you, I definitely did not learn enough about taxes in high school or college. But that's all right because there's no better time than the present to learn more. First, let's have a quick refresher on deductions. They're exactly what they sound like. Specific expenses you've incurred this year that are deductible from your income and can lower your tax bill. One of the most puzzling things about taxes is knowing what you can and can't claim. For example, did you know that you can claim state sales taxes as a deduction? On your tax return, you can choose between deducting state and local income taxes or state and local sales taxes. For states like Texas, Florida, and my beloved Tennessee, this may mean you want to consider writing off the sales taxes because you already don't have state income taxes. Keep in mind the total of deductions for state and local income, sales, and property taxes is limited to $10,000 per year for individual filers. Moving along, did you know you can claim property deductions? That's right, you're able to deduct mortgage insurance premiums, home mortgage interest, and real estate taxes paid to the taxing authority for the year. Perhaps you felt generous this last year. Good karma may be coming your way because you can claim charitable contributions. You can deduct charitable cash donations as well as giving away items or property to qualified organizations. Let's not forget to claim the contributions to your individual retirement accounts. The total of your contributions to all of your traditional and Roth IRA accounts is $6,000. Plus another $1,000 for those over 50 years old. If you have a traditional IRA, your contributions are tax deductible. Contributions to a Roth IRA are not deductible. Maybe you had a big time medical expense this last year. Well, you may be able to claim medical expenses to lower your tax bill. In general, you can deduct the amount of qualified, unreimbursable medical expenses that exceed 7.5% of your adjusted gross income for that year. That's a mouthful. The point is, if you had a large hospital bill or other medical expenses that weren't covered for you, you may be eligible to claim this deduction. These are just a few of the many deductions you may be able to claim on your tax return. Remember, you always have the option to take the standard deduction. These are the 2021 standard deduction amounts for the different types of filers. If the total of your claims would not add up to more than these values, it may be best to go with the standard deduction. And there you have it. Not the most fun subject, but one that you may find useful as you prepare your tax return. A brief heads up, this is a sponsored video. MoneyLion and I have partnered to make important financial lessons easier to understand. My name's Hankwitz, and I'll see you on the next episode of Beyond the Wallet.